Are you tired of trying to make sense of the complex and ever-changing world of investing? Have you ever wished that there was a simpler way to invest and make money without getting overwhelmed by all the technical jargon? If so, you're in luck. Mastering common sense investing is an effective and straightforward way to reach your financial goals. In this video, we'll explore the basics of common sense investing and how it can help you achieve financial success. Where did the term come from? Common sense investing is a phrase that has gained popularity in recent years, but its roots can be traced back to the teachings of Benjamin Graham, a legendary investor who is the father of value investing. In his seminal work, The Intelligent Investor, published in 1949, Graham laid out a set of principles that emphasize the importance of analyzing a company's financials, seeking out undervalued stocks, and having a long-term perspective. Graham's ideas were embraced by Warren Buffett, who went on to become one of the most successful investors of all time. Buffett has often cited Graham as a major influence on his own investment philosophy, which has also been described as common sense investing. In a nutshell, common sense investing is about focusing on the fundamentals, avoiding short-term market fluctuations, and taking a disciplined, rational approach to investing. It's an approach that emphasizes patience, prudence, and a long-term view. What is common sense investing? Common sense investing is a term coined by legendary investor John C. Bogle, the founder of Vanguard Group. The concept behind common sense investing is simple. Invest in a low-cost, diversified portfolio of index funds and hold them for the long term. It is a strategy that emphasizes common sense, simplicity, and discipline in managing your investments. At its core, common sense investing is about avoiding unnecessary risks, reducing fees, and taking a long-term view of investing. Instead of trying to beat the market or time the market, common sense investing suggests that investors should aim to match the performance of the overall market over the long run. One of the key principles of common sense investing is diversification. Rather than investing in just one or two stocks or sectors, investors should spread their investments across a variety of asset classes, such as stocks, bonds, and real estate. This helps to reduce the impact of any single investment on your overall portfolio. Another key principle of common sense investing is keeping fees low. High fees can eat into your returns over time, so it's important to choose investments with low fees, such as index funds. Finally, common sense investing emphasizes the importance of patience and discipline. Investing is a long-term game, and trying to time the market or make short-term bets is often a recipe for disaster. Instead, common sense investors focus on staying the course and sticking to their long-term investment plan. In summary, common sense investing is a straightforward approach to investing that emphasizes diversification, low fees, and a long-term view. By following these principles, investors can increase their chances of achieving financial success over the long run. Why is it important? Common sense investing is important because it provides a solid foundation for financial success. It involves making rational decisions based on long-term goals and a realistic understanding of the market. This approach to investing helps avoid the pitfalls of emotion-driven decision-making that can lead to costly mistakes. Furthermore, common sense investing emphasizes diversification, which helps to minimize risk and maximize returns. By spreading your investments across a range of assets, you can reduce the impact of any single investment going sour. This strategy also helps to cushion your portfolio against volatility in the market. Another benefit of common sense investing is its simplicity. Unlike complex trading strategies, common sense investing doesn't require constant monitoring or expert knowledge. It's a straightforward approach that anyone can adopt and maintain. Finally, common sense investing helps to reinforce good financial habits. By focusing on long-term goals and avoiding impulsive decisions, you can cultivate a disciplined mindset that will serve you well in all areas of your financial life. In short, common sense investing is important because it provides a solid foundation for long-term financial success. By avoiding costly mistakes, diversifying your investments, and cultivating good financial habits, you can build a portfolio that will grow and thrive over time. How can you get started? Now that you understand the importance of common sense investing, you might be wondering how to get started. The good news is that it's easier than you might think. Here are some tips. 1. Set realistic goals. Before you start investing, you need to define what you want to achieve. This will help you choose the right investments and keep you motivated. Be specific and realistic about what you want to achieve and set a time frame for achieving your goals. 2. Educate yourself. Knowledge is power when it comes to investing. You don't need to be a financial expert to invest, but you should have a basic understanding of different investment options and how they work. Start by reading books, blogs, and articles about investing, or take an online course. 3. Start small. It's important to start small when you're new to investing. You don't need to invest a lot of money right away. Instead, start with a small amount and gradually increase your investment as you learn more and feel more comfortable. 4. Diversify. One of the key principles of common sense investing is diversification. This means spreading your money across different types of investments to reduce risk. This can include stocks, bonds, mutual funds, and exchange-traded funds. 5. Stay disciplined. Investing can be a roller coaster ride, with ups and downs along the way. It's important to stay disciplined and avoid making impulsive decisions based on short-term market fluctuations. Stick to your plan and don't let emotions drive your investment decisions. By following these tips, you can start your journey to becoming a successful common sense investor. Remember, investing is a marathon, not a sprint, so stay patient and focused on your goals. Good luck! What do you think about our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.